Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 7th of November. I'm Daniel Lam, your host for the podcast. When I first started doing this podcast 15 months ago, my predecessor, Manpreet Gill, told me that I should always strive to discuss a diversified set of asset classes. But today, I'm going to break this piece of wisdom and talk about US equities yet again. And that's because S&P 500 had its largest weekly gain this year, as US 10-year Treasury yield pulled back by a whopping 40 bips. It's not just the magnitude of these moves. Many of the brokers are changing the narrative from risk-averse to risk-on, and some even saying Goldilocks. Well, last week, we discussed an unexpectedly moderate Treasury quarterly refunding projection, weakening US economic surprise, and relatively less hawkish FOMC. And of course, besides the weak ISM manufacturing number that we spoke about, last Friday, non-farm payroll was lower than expected, and this has increased the probability of peaking rates, and all the aforementioned points contribute to risk on. Now the key question is, will there be leaks in this rally? And the short answer is probably yes. Now let's dig deeper into the implications of the slowdown in US data that came out last week. Now in general, there has been increasing correlation between the important US macro data since the end of last year. So payrolls, for example, have been closely linked to US consumption trends, and thus the weakening NFP could signify slowing consumption. In fact, if you look at the high frequency US card spending data through the last week of October, it suggests that there is yet to be material recovery in growth rates from last month's deceleration, meaning little upside on the consumption front in the near future. And of course, all these macro data feed through to the US Economic Surprise Index, which typically tracks these data with a month's lag. So the US Economic Surprise Index is susceptible to some material drop over the next 2 to 3 months. And all these, combined with the ongoing deceleration in US inflation, means that US 10-year yield is likely to be kept probably around the 4.6 to 4.8 area. And this is positive for risky assets and also long-duration trades. So we reiterate our view on short US dollar, long-dated DM-IG government bonds, and long US growth stocks. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.